Hey, good morning, options traders, and happy Friday, everyone. I received a really good question. It's a basic one, but a very important one from one of our new traders asking how many contracts should you trade? And it's a good question because you could either trade the equivalent share amount or you could trade the same dollar amount. And a lot of times new traders are tempted to trade in equal dollar amounts. In other words, if they're willing to spend $10,000 on the stock, they'll put $10,000 into the option. So could you do that? Sure, you could certainly do it, but is it a good idea? Well, let's take a look at how you should make this decision. So to do that, first of all, understand that option contracts control 100 shares of stock. That is generally speaking when they're first listed. If you have splits or other corporate actions, it may certainly alter that. You might have a 3-for-2 split where each contract controls 150 shares, or maybe a reverse split where it now controls fewer shares. But generally speaking, they control 100 shares. But regardless of how many it controls, that's what you need to figure out. And then you can compare it to the alternative of buying the actual shares. So the next thing to realize is that call options are a form of insurance. Now, I just talked about this in a recent video. All options are a form of insurance. Calls are a little more difficult to see, but they still give us good downside protection. So this is an important bullet point right here. Call options are a form of insurance, and we want to make sure that we are putting that into play. So the basic rule when you are trying to figure out how many contracts to trade is to trade in equivalent shares. And so for instance, let's say that our stock is trading at 100 and you're willing to buy 100 shares or $10,000 worth of stock. Now at that same time, there is an at-the-money $100 call trading for 5 or 500 bucks. Remember that each contract controls 100 shares, so that price that you see on the option, $5 in this example, must be multiplied by 100. So you could either spend $10,000 for the stock or $500 for the option. But regardless of which choice, whether you buy the call or the option, they both control 100 shares. And it's this right here that you want to focus on. This is what it means to trade in equivalent shares. If the option for some reason controlled 150 shares and you were willing to buy 150 shares, then yes, you could buy one call option. But what you don't want to do is this, is to say, well, I'm willing to spend $10,000 on the investment, whether it's in shares or the option, so let me put $10,000 into the calls or buy 20 contracts. Now again, could you do that? Of course you could, but it's just not a real good idea. And there's a couple of key reasons. The first is that you are now controlling 2,000 shares. And if you were only willing to buy 100 shares, that tells me that your comfort level is with 100 shares or 100 deltas. You're probably used to how quickly a stock can gain or lose by owning 100 shares. And if you buy the same dollar amount, though, and are now controlling 2,000 shares, that's 20 times the size and the speed. Now, of course, on the way up, it's going to be a lot more fun, but it's going to be super painful on the way down. And what's going to happen if you do this? If you put the $10,000 into the call options, the risk is going to end up managing you. And that's why it's a really bad idea to trade in equal dollar values. So for instance, here's what it looks like graphically. Here's our 100 shares of stock in blue, dollar for dollar up and dollar for dollar down. And here is our one call option in green trading for 5. So there's our bend right at the 100 strike. And you can see over here at the left, the maximum loss is 500 bucks. So there's your insurance. Notice that if you bought the shares instead in blue, you could certainly lose more than 500. Now, the point where the blue and green lines cross, what's called a crossover point, is when they're equal. They would both lose 500 bucks at this point. So in this example, your insurance really kicks in below 95. That's when the green line flattens out, but the blue line continues to head into losses. So this is really the two different choices that you have. Now also, by buying the option in green, we do shift out our break-even point a little further, and we have a higher probability of loss because there's a much greater chance that the stock hits 100, our strike, before it's going to hit 95. in blue down here where both the shares and the call would lose the same amount. So we have to take all of that into consideration. But if we're bullish and we're fairly confident that stock's going to be above 100, it's nice to have this insurance policy. But watch what happens to this graph right here. I'm going to keep the blue and the green lines the same, but I'm now going to overlay 20 of the $100 calls. And watch what happens. Look at that. These deltas here are virtually flattened. This amount of risk, the angle that this red line is coming up on, the 2,000 shares, just dwarfs what you would have had whether you bought the shares or the call, buying one contract or 100 shares. And this is what's going to get you into trouble. Now, as I mentioned, if the stock happens to rise, yeah, it's going to be a lot more fun on this ride on the way up than had you bought 100 shares or one call. But that's not what we're worried about. Risk management is not about what we could make, it's about what we could lose. So it's this part right here, just below where these blue and green lines are, that is the real danger. And that's because, again, you would be controlling 2,000 shares of stock even though you put $10,000 into the calls. And that's giving you a much higher amount of leverage. Now, is it true that if you did buy 20 contracts that you still have an insurance policy? Well, it all depends on what you're comparing it to. Sure, if you were instead willing to buy 2,000 shares of stock, that's what it would look like. And so yes, 20 contracts would still give you, proportionally speaking, the same insurance. But that's not what you're doing in this decision. You're trying to decide on one call option that controls 100 shares or 20 call options, which is $10,000 worth. And that's the big danger that people make. So the main thing to take from this is to just remember the basic rule. You want to keep your position sizes the same. And when we talk about the position sizes, we're talking about equivalent share amounts. So in this example, if you were willing to buy 100 shares, then yes, you could buy one call. If you're willing to buy 200 shares, then you could buy 2 calls, and so on. You want to keep those share amounts the same. But what you don't want to do is to buy the same dollar amounts. So in this example, you were willing to pay $10,000 for the stock. Don't take that same $10,000 and put it into the options and go, gee, look at all the leverage I have. Because again, that leverage can be great if it's moving in your favor, but if it even dips a little bit against you, that risk is going to manage you. You're going to get triggered out. You're going to get scared, close down the position, and end up with large losses. So again, especially when you're starting out, be sure that you keep the position sizes the same, meaning that you're always controlling the same number of shares with the option that you were willing to control with the stock. And for anyone who'd like to learn more about the art and science of options trading, please check out the Alpha Trader course, Strategy Lab, and a technical analysis course. You can find it all at optionsatoz.com. Also, please join us on the Facebook trading group, Options A to Z, and you can find a link in the description below.